Hi, this is Kerry Artac with Artac Advisory, and this is a video supplement to February's ETF allocation strategy. Our monthly ETF allocation strategy is an 8 to 12 page newsletter published at the beginning of every month, offering insightful technical analysis across a broad range of the more popular, higher volume exchange-traded funds. We break our analysis down into four broad asset classes: equities, bonds, currencies, and commodities. The video segment is intended to underscore the headlining portion of each monthly letter. And in the February edition, we headlined with the fact the two primary blue chip indexes, the S&P 500 and the Dow Jones, as represented by the popular SPDR and Diamond ETFs, posted meaningful longer-term buy signals at the end of January. Secondary confirmation was provided in the popular Russell 2000 Small Cap Index, that ETF symbol IWM. So in the following 6 slides, we'll recap the analysis presented in February's ETF letter to underscore the longer-term significance of the recent blue chip buy signals, as well as the illustrated upside objectives for 2013 and beyond. This chart is an expanded version of the one illustrated at the top of page 1 in this month's ETF allocation strategy letter. And it shows that at the end of January, the SPY, or better known as the SPDR ETF, posted a meaningful long-term buy signal by closing the month above the 149.23 channel top. It was by a marginal degree. Yet as we'll see later in this presentation, both the Dow and the Russell 2000 settled above this respective channel top by a much wider margin. Yet given the fact this signal is fresh, there is a degree of fragility to it. And so February really needs to post a higher month-on-month settlement to essentially lock in this longer-term signal. And that would mean an end-of-month settlement above 149.70. And assuming that transpires, then over the next 5 to 8 months, this ETF should continue onward and test the 164.97 4-year ascending channel top, which is able to contain strength into later year. Though highly unlikely between now and mid-year, a penetration of this 164.97 formation indicates 3 to 5 more months of upward continuation to the next meaningful resistance threshold in the 182.54 area, not illustrated on this chart, but it is on the next chart, which is a much longer-term view of the S&P 500 cash index. By using the underlying S&P 500 cash index, we can make good use of its more extensive historical data. This chart shows activity dating back to 1971. The small drop here in relative terms was the October 1987 crash, and you can see the series of rotations starting with the 2000 high to present day. The index price levels illustrated here can be translated to the SPDR ETF by merely shifting the decimal point to the left by 1 digit. In other words, the formation at 1492.76 would be closely correlated to a SPDR ETF price of 149.27. While our previous slide shows a 5 to 8 month objective in the 164.97 region, by making use of the underlying S&P 500 index's longer-term data, we can see a 25-year formation at 1825.43, or in SPDR ETF terms, 182.54, which is now considered a 12 to 18 month objective following the January buy signal. This channel top at 1825.43 is indeed able to contain annual highs when tested, upon which the market is vulnerable to retracing back to 1492.76 within a full year or so of activity. However, I'm also showing this chart to illustrate what I believe are the longer-term implications of last month's buy signal above the 1492.76 formation. If you're familiar with the basic tenets of technical analysis, you know that to break out of an extended range, the market will generally reduplicate the previous scope of that range in the respective direction of the breakout. In other words, if we take the 2007 high and the 2009 low as our extremes, simple math will tell us that a 100% swing beyond the 2009 high will take us into the 2379 to 2485 region. So this is an upward objective that is really a 3 to 5 year target. And how do we get 3 to 5 years? Well, we can assume that the market will probably maintain the breadth and sustainability of these runs off the '02 low to the 2007 high. This was, well, it was less than 5 years. It was more like 4.5 years. This is about a 3.5 year move. So 3 to 5 years, expecting solid resistance in the 1825 area. Let's just call it 182.54 because we are speaking of the SPDR ETF. This is a formation that can contain highs for a year or so when tested, but the longer haul, if you're managing a portfolio over the longer haul, we are now in the beginning stages of a longer-term secondary bull run. And though certainly not likely over the course of 2013, a monthly settlement above this 182.54 or in underlying S&P 500 index speak 1825.43, a monthly settlement above this formation should yield hyperbolic upward trade. We should get to this area within 12 to 18 months, but we are way ahead of ourselves. In the next 4 slides, we'll take a look at both the Dow ETF or the Diamond Fund and the Russell 2000 Small Cap Index, that ETF symbol being IWM. Both markets present a very similar structure and correlating buy signal to last month's S&P 500, and to avoid an overly repetitive presentation, we'll move through the remaining slides at a slightly more accelerated pace. This is the Dow Jones ETF, or the DIA, better known as the Diamond Fund, and you can see the same formation that we illustrated previously in the S&P 500 or the SPDR Fund. We more comfortably settled above in the Dow at 136.05. This is actually February support, above which we should, over the next 5 to 8 months, reach this 156.30 formation, or in Dow terms, 15,630. But over the next 3 to 5 years, as illustrated previously in the S&P 500, we have longer-term upside objectives that should reach much higher. And we'll take a look at those in the next slide. This is a more condensed version of the previous diamond chart. You can see the buy signal last month above the 136.05 formation, the 5 to 8 month objective to 156.30. But longer haul, you can see our 3 to 5 year objective. Once again, we're merely breaking out of a 13-year range. So, whether you're analyzing a 30-minute bar chart going back several days, or a monthly bar chart, in this case going back over 13 years, when you break out of a well-defined range, you generally reduplicate the scope of that range in the respective direction. And so in this case, we're subtracting the 2009 low from the 2007 high and swinging at 100% back to the upside, which takes us into this 210.08 to 219.12 region, which in Dow Jones terms is 21,000 to 22,000. Yes, that is a 3 to 5 year objective, so long as we continue to hold and settle month by month above this 136.05 formation. So now let's move on to the Russell 2000. This is the Russell 2000 ETF, small cap fund. Symbol is IWM. And you can see a very similar structure over the last 10, 12 years. I do like this structure even better. It's a little bit more technically relevant. You've got a early 2011 high that held beautifully off of this formation. And the result was 5 or 7 months of downward activity before resuming an upward course to the present day. At the end of January, we posted a comfortable buy signal above this formation. So the small caps are suggesting, not only suggesting, but sort of screaming upside trade for the next 5 to 8 months. This one could take a little bit longer, but if we recreate the same volatility that we saw here off this 2011 low, it certainly could be in the order of 5 to 8 months. This is a formation that can contain 2013 highs, but like with the other 2 previous indexes that we've illustrated, we do have higher upside objectives if you're looking out over the 3 to 5 year time horizon, and we'll get to those right now. This is the Russell 2000 cash index, the underlying index itself, and you can see it looks identical to the previous IWM Russell ETF that we illustrated in the previous slide. The numbers are going to look a little different. The decimal point is shifted to the right by 1. whereas this formation on the ETF was 87.50. We've got for the month of February cash index support at 872.11. But if you want to translate that to the Russell 2000 ETF, shift the decimal point over, and you've got a range of support basically between 87.21 and 87.50 for the month of February, above which 5 to 8 months of upward continuation is expected to this 1050.69 formation. But like the other two indexes that we've covered in this video, you do have longer term objectives that we need to account for if you are a longer term investor. And 1370.24 or 137.02 in ETF terms, this is the longer term objective. The same scenarios apply, the same range breakout formulas, so forth and so on. Very simple calculations, but keeping it simple does work in technical analysis. And these are fresh buy signals. I do need to re-emphasize that. So because they're fresh, because they're new, they're very fragile, and they are susceptible to being challenged over the course of February trade. And so we need to see all three indexes settle the month of February, not only above these formations that we've illustrated, these horizontal long-term formations, but ideally above January's settlement price as well, in order to provide secondary confirmation. And if so, bullish follow-through is expected not only into later 2013, but as we've been saying, for the next 3 to 5 years. On the other hand, if February settles lower, especially in the S&P 500 or the Spider Fund, for that buy signal was by a marginal degree, then buy signal failure may be in the works. And if so, the markets covered here today may be poised for corrective downside activity into mid-year. We are not there yet. And we will be watching these closely over the months to come, and we will be presenting them again in the March ETF allocation strategy. So we look forward to your return. Thanks for watching today. If you have any questions about anything seen in this video, please don't hesitate to give our office a call, 262-586-2510, or email us at info@artacadvisory.com. You could also visit our website at www.artacadvisory.com. Take care.